Hey friends of future millionaires, Gregory Pierre Louis here, the backpack entrepreneur. In this video, I want to show you how to avoid a margin call, okay? You see, margin trading is a way for traders with very limited capital to make significant profits. See, it's allowed me to start with just $100 and allowed me to create life-changing income. You see, it's allowed me to horseback ride through the warm waters of Montego Bay, Jamaica. It's allowed me and my daughter to zip line through the rainforest of Costa Rica. You see, if you don't understand the concept of margin, or you struggle with not knowing what to do when faced with a margin call from your Forex broker, then you'll definitely experience the shock of blowing your trading account, okay? And here's an illustration of Forex traders blowing accounts. You see, it's a horrible feeling. A lot of negative, a lot of lost money. You're in the hole. It's painful. You see, I don't care who you are, it'll make a grown man cry. So here are 5 ways to avoid a margin call, all right? The first way is to know what a margin call actually is, all right? Understanding what a margin call is and how it works is the first step in knowing how to avoid one, right? You see, most new traders want to focus on the other details of trading, such as technical indicators or chart patterns. But very little thought goes into any of the other important elements, such as margin requirements, equity, used margin, free margin, and margin levels, right? And if you're hit with a margin call out of the blue, then that usually means you have no idea as to what causes a margin call and are opening trades or positions without considering margin requirements, right? And if this is you, then you are doomed to fail as a trader. And that's guaranteed, okay? A margin call occurs when your account's margin level has fallen below the required minimum percentage level, right? And at this point, your broker is going to notify you and recommend that you deposit more money into your account to meet the minimum margin requirements. Now, the second way for you to avoid a margin call is to know what the margin requirements are before you decide to place any orders, right? Knowing the margin requirements before you open any trades or positions, that's very crucial, okay? You have to account for the amount of margin that will be deducted from your free margin, as well as having some additional margin so your trade will have some room to breathe, right? So when you have multiple pending orders open, it can get quite confusing. And if you're not careful, when these pending orders get filled, it could result in an unexpected margin call, okay? So to avoid such a tragedy, it's crucial. It's super crucial that you understand the margin requirements for each trade or position that you plan to enter, right? So the third way for you to avoid a margin call is to use stop loss orders or trailing stops, okay? If you really don't know what a stop loss order is by now, then you're surely on your way to losing a whole lot of money, right? As a refresher though, a stop loss order is basically a stop order sent to your Forex broker as a pending order. And when that price moves against your trader position, your stop loss order protects you. It's like your mama, right? A stop loss order or a trailing stop order prevents you from taking any further losses, which helps to prevent you from getting a margin call, right? So the fourth way for you to avoid getting a margin call is to scale in trades or positions rather than entering all at once. So what does that mean? Another reason why some traders end up with a margin call is that they misjudge price movement, okay? Let me give you an example. You think GBP USD has gone up way too high and way too fast, and you believe that there's no way price can go any higher. So you open a huge short position, right? This type of overconfident trading increases the probability of triggering a margin call. And to avoid this, one approach is known as scaling in, okay? Some of you probably heard of it before. Instead of trading one standard lot right off the bat, start off with trading one mini lot. Then add or scale in trades or positions as the price moves in your favor, right? That makes a lot more sense. So while you continue adding new trades or positions, you can also start moving the stop loss orders on the previous trades or positions to reduce any potential losses or even lock in some profits, right? See, scaling in can help you skyrocket your profits while trading risk-free. And when you combine all your trades and positions at the end of the day, at the end of the week, or even at the end of the month, you will be one happy human being, right? The fifth way for you to avoid a margin call is to know what you're doing as a professional trader, okay? See, it's not uncommon to hear about new traders who get hit with a margin call and not know what just happened to them. These types of traders are just focused on how much money they can make and don't actually know what they're doing and don't fully understand all of the risks that come along with trading the financial markets. Don't be that trader, please. As a professional trader, risk management should be your main priority, not profits, okay? So, those are the 5 ways to avoid a margin call. You should pay attention to the currency pairs that you're trading and their margin requirements. Have discipline and know when to cut your losses so you can trade another day, right? And my final piece of advice to you is to understand volatility and check for any major news events that could trigger price spikes that could put your account at risk of a margin call, right? So I hope this video was helpful. I hope you got value from this video and you learned how to avoid a margin call in at least 5 different ways. So I'll see you guys in the next lesson.